Is AMT cheap? That's what we're going to find out by the end of our video today. We want to go and look at the historical prices, how it has performed in the market over the last 10 years. We want to take a look at their balance sheet and income statement, how their revenue is and their bottom line. We want to look at their dividend safety and some key financial metrics, how it's performed year over year. And we want to end the episode with our stock valuation model. What is the intrinsic value of American Tower Corporation? With our margin of safety, what is our acceptable buy price for this company? So let's find out if this REIT is cheap. Year to date, they are down 10% as we can see here, currently offering a yield which isn't too shabby at 3.26%, and it's heading towards that 52-week low of $178. Now, if you've been holding this company for the last 10 years, without dividends, you would be up 167%. So for me, that's quite a positive return if you've been holding that for the last 10 years. Again, it does depend when you have bought that. Now, if we have a quick look at the 5 years, 40%. So it really does depend on that. Now, let's jump straight into their revenue and see how that has progressed year on year. So over the last 5 years, AMT had revenue in 2018 of $7.4 billion. And in 2022, 5 years later, $10.7 billion. So there was nice growth. I know year on year you could argue that there was minimal growth, some years better than others. But we want to be taking a good look, whether it's a 5 year or 10 year, to get a good overview of a business. Now, what I also want to take a look at and see if their net income is also increasing over that period. Otherwise, there could be other issues we need to look into. So $1.2 billion in 2018. And in December 2022, a $1.765 billion. So roughly nearly 40 to 50% increase, which is positive. But we can see that from 2018 to 2021, it did increase and then decrease from 21 to 22. So something we should just keep in mind when looking at our financial metrics coming up now. So when we jump into, one thing before we do jump into our financial metrics, let's take a look at the balance sheet. As always, let's have a look at their cash balance versus their total debt to ensure there are no red flag or any issues we need to point out straight away here. So we can see the cash and cash equivalents in 2018 at $1.2 billion and in their latest quarterly report, $1.8 billion. So it has increased over the last 5 years, which is positive in my opinion. And when we take a look at that total debt that we can see over here, their total debt has gone from $21 billion and has more than doubled in the last 5 years. Their latest quarterly report at $46.9 billion. So for me, this is a worry, a potential red flag indicator. And when we now take a look at the metrics, we're going to find out whether or not they are able to pay off this debt and that interest year on year, or if it is an actual red flag that we need to worry about. American Tower, now dividend safety 78, making it safe, and market cap of 90 billion, so a large cap company. Some key metrics here: they've paid off dividends 10 years without a reduction. Interestingly, in the last recession, 07-09, their sales was 7.8% positive, which is above the average growth, which was in fact negative growth. So this is positive if you believe we are heading into a recession, or if you think in fact we are in one. Now, although their recession return was negative 37%, it did beat the S&P 500's return of negative 55%. So one thing just to take into account. Now, dividend growth, I'll say on every single video because it is so important. US inflation rate 4%. If you are not getting 4% increases in your salary, in other income producing assets, at least 4%, you are losing your purchasing power. AMT's last full year increase 21 to 22, 12%. So above the US inflation rate, very positive. And the last 5 years and the last 20 years, double-digit dividend growth, which is lovely to see in my opinion. 21% if you'd bought this stock 10 years ago, 21% year-on-year increase. Very, very positive. So I like what I see so far. Dividend yield theory states that when the yield is above that 5-year average, then it is undervalued. So this first theory states that AMT is currently undervalued. Again, we look at lots of different models and then come to our conclusion. We don't look at any theory in isolation. This also shows some undervaluation when the forward P to AFFO ratio is below the 5-year average, currently at 18.9. And according to our sector comparison of the real estate, it is slightly above that However, we will take a look at this in our multiples valuation model. I like to see companies that are towards their 52-week low, whether that's psychological or not. However, that does not mean they are undervalued. And likewise, if they're at that 52-week high, it does not mean they are overvalued. Now, if you've been watching my other videos, you know that I'll always say we only look at the free cash flow, whether it's the payout or the free cash flow share per year-on-year increase. However, for REITs, we actually look at the adjusted funds from operations, the adjusted FFO payout ratio. As we can see here, the free cash flow payout ratio is not good when looking at REIT's ability to pay dividends. So adjusted FFO, we like to look for below 80 to 90% depending on your risk as an investor. And for me, this is very positive to see. Even though it has increased over the last 10 years from 30% to 58%, it's still below that 80 to 90%, which we would expect from a REIT. For other dividend stocks, as you've seen, it would be below 60%. So for me, given that AMT is below that 80 to 90% that I like to see, this is a positive sign. Likewise, we don't look at the free cash flows per share either for REITs. So looking at the adjusted funds from operations, 2013, $3.68, and 2022, $10.10. What I quite like to see when I see this is that the increase year on year has been quite nice. It's not large increases and large decreases and increases and so on. There are some years that we can see that were a slight drop, but then it has picked up over the years. So for me, this is a positive sign of year-on-year growth. Sales growth, again, for moderate growth companies like AMT, we look for 5 to 10%. And for me, looking at this data, we can see that they do beat that quite significantly. 2013, 17%. There are some years of double digit. You have 2019 and 2020 where it was single digits. However, 2022, 14%. I would take this as very positive. And if looking at the overall view at the bottom, 3.36 billion sales in 2013, 2022, 10.7 billion. So that's around a 3 times increase. For me, that's very positive and I like to see that. Shares outstanding. Again, typically, if you've seen my other videos, we like to see when companies return excess cash to shareholders by effectively buying back shares. With the REITs, we typically tend to see the opposite, where they are issuing shares for different reasons. Now, for me, looking at this is actually not too bad. There aren't large increases in shares. So overall, I would say this is nothing really to worry about. Obviously, we do need to keep an eye out if this suddenly doubles or this goes up by a large increase over the next few years. Return on invested capital, ROIC, 10% plus is what I like to see. However, what we can see here is that it's slightly below that over the course of the last 10 years. However, I do believe that REITs don't have that capacity that other companies do to have a very high return on invested capital. However, for me, I still like to see around 10%, but looking at the last 2 years, 6 to 5%, it's not the worst, but it's something, again, that I would like to keep an eye on, that it doesn't suddenly drop further and further. Operating margin, again, we don't look at the free cash flow margin, but operating margin around 30% and just above 30%, again, is positive to see. Like it says here, more stable operating margins can be signs of advantaged businesses. So I like what I see in terms of their operating margins. And as we saw in the income statement, with their revenues, they are able to produce a nice bottom line net income. Net debt to earnings before tax, depreciation and amortization. As I mentioned, they had doubled their debt, which was a slight worry for me over the last 5 years. And what we can see here is that while we look for below 5.5 for REITs with this metric, we can see the AMT over the last 5 years has been around that 5.5 in 2021 at 6.73. So this is a slight worry for me and something that if I was to invest in the company that I would definitely monitor, ensuring that they are able to pay off their debt year on year due to that high figure. So just something to be wary of for investors. Net debt to capital, essentially saying 78% in 2022, the company financed from debt as opposed to equity. We like to see around 0.5, so they are taking on a lot of debt for their financing. Again, coupled with this information we spoke about is a slight worry, something just to be aware of as a potential investor. Stock valuation model, let's run through this. If you want to grab a copy, do check the pinned comment. As always, smash the like button and the subscribe button if you are enjoying the content. Let's jump straight into Graham's valuation model. Now, this is purely for information purposes, just to show you. However, For REITs, we do not use Graham's valuation model. It is not a model that works for REITs. However, I've just put it here only for educational purposes. The earnings per share, the growth rate that is expected by Wall Street analysts, and the average yield on AAA corporate bonds. It gives $63.82, but as I mentioned, this is just for information purposes and is not part of our model for today. So, REIT multiples valuation model. We have 4 companies which are in a similar sector or similar business size to AMT. We have CCI, Crown Castle. Do let me know in the comments if you want me to do another video, but on CCI. We have PSA, Public Storage, Welltower, and PLD, Prologis. We put our stock prices and we get the P to AFFO multiple. Once we get our average P to AFFO multiple, we input the current price for AMT and that P to AFFO multiple. And this gives us our stock price for AMT based on the REIT multiples valuation model of $223.11. As we can see, this shows upside to the current price and it's below that 52-week high. Now moving on to the DDM, dividend discount model, something I do quite like about this stock is their growth rate in terms of their dividends. As we can see here over the last 5 years, nice growth. What I've done is I've gone for a growth rate of 6%, slightly below, well in fact quite significantly below their average growth rate. However, if we do enter into a recession and they are unable to keep those levels of debt low, I can see the dividend essentially being reduce, not in terms of cutting the dividend, but just the increase not being as high as we have seen. This gives a DDM price of $248. Again, significant share price appreciation to the current prices and still below that 52-week high. Now, last model, discounted cash flow model, we've inputted the free cash flow year on year and we can see here the growth, average growth rate being around 12%. Now, I've gone for a growth rate in line with analyst estimates at 18%, and what I've done in the model is I've used the starting point of 2021 as analysts believe it will pick back up in 2023 to what it was in 2021. As we can see in 2022, it did drop 47%, so that's just something to note here. Again, then using our growth rate as expected by Wall Street analysts, and then our discount rate, we get our present value of future free cash flows and terminal value. We add this with our cash and cash equivalents, subtract our total debt, and we arrive at our equity value. Now, we then divide by our shares outstanding, and we get the DCF price of $221. Again, upside to the current share price. As always, smash the like button if you enjoy the content. Smash the subscribe if you are not already subscribed and want to continue receiving these great videos, and do let me know your thoughts in the comments. So now the intrinsic value is essentially the average of these 3 models that we have just run through, which shows our intrinsic value at $230.86, showing upside to that current share price, but below that 52-week high. Now, given the current price at $193.40, for your margin of safety, you typically be looking for around 10%, depending on what you believe in. For me, margin of safety, I look at 10% for companies that I believe to be strong, have wide moats, and are a great business. Now, with a company like this, if you were looking for a margin of safety of 10%, you'd be looking for an acceptable buy price at $207. However, for me personally, I would be looking for a larger margin of safety. I'd be looking for around 20%, given the downside of this, given they have had as we can see here, I will show you very quickly in terms of their revenue. We can see that their revenue did decrease, their net income. But anyway, that's my opinion. I'd be looking for a 20%. So my acceptable buy price would be $184.69, slightly above that 52-week high. Now, we're going to end the episode with the Wall Street price forecast. They're forecasting around $238.25, slightly above our intrinsic value and still significant upside to that current trading price. As always, let me know your thoughts in the comments. Let me know whether you're a shareholder or whether you're considering buying. And as always, have a great day and catch you on the next episode.